But let's focus on a couple of currency as well as global cues. We have Koen Goh, the senior forex strategist at ANZ Research, joining in for that. Koen, hi, good to see you in today. First, wanted to start by asking you about, the MSCI, which is likely to come out with its review today and is likely to announce whether they're going to include the China A shares or not in its index. What does that mean for people in investing into India, and if you could explain the entire concept to us as well.
Sure, a good day to you. MSCI is due to make a very important announcement later today at 5 p.m. New York time on whether or not to include China A shares as part of their emerging market benchmark indices. The reason why this is important is that a lot of passive fund managers who follow the index will be forced to buy China A shares if MSCI decides to include them in. At the moment, China A shares are not included in any of the major benchmark indices, which means fund managers that follow the index do not need to get any exposure. Now, I think there are going to be two important ramifications from today's decision. If MSCI do decide to include China in there, then the first implication is that fund managers all around the world will need to start adding China A shares as part of their portfolio. So that means we're going to see increased equity inflows into China over time. I think the second implication is more interesting because if China were to be included in the benchmark indices, then naturally that means other indices that are in there at the moment, their weightings will need to be reduced. Therefore, that will result in some selling as fund managers undertake portfolio rebalancing. Now, we don't know for sure whether or not MSCI will include China in, and even if they do, we're not quite sure what the exact weightings are, and we don't know how much the other indexes will get reduced by, which is why the market is closely anticipating the decision that's going to come out tonight.
All right. Hi, Koen. Thanks so much for joining in this morning here in Mumbai, at least. So you said that the first part, maybe in fact they'll be going ahead and they'll have to pick up some of those Chinese A-list shares. But do you think it's already played out in terms of India? Because India's corrected close to around 12% from the top, and in the last 5-6 trading sessions, we have seen selling pressure close to around 5.5% roughly. So do you think the second part of the story has already played out, that they've already in fact sold off whatever they wanted to in India, and in fact now they're prepared to move into China? But if that doesn't happen, then maybe we could see those flows come back?
I don't think the fund management industry has actually tried to front-run this decision because, quite frankly, the market is quite divided over whether or not MSCI is going to include China in there. So for that reason, I don't think anyone's actually tried to preempt the decision. Therefore, the selling that we've seen from the Indian equity market, personally, I don't believe is related to the MSCI decision. I think it's mainly due to the fact that the market is concerned that the Fed will start hiking rates sometime this year. We think September is the most likely timing, bringing a stronger dollar and higher U.S. interest rates, which typically are not a positive environment for EM currencies.
Okay. Koen, is it possible that if in case this is announced and the China A shares are included in the MSCI, then there would be a reallocation of fresh funds that would take place? So that means that there would be a fresh outflow, FII outflow that we could see in other emerging market indices, and then that goes into China. And hence, how susceptible would India be in terms of fund outflow risk as compared to its other emerging market peers? Say, for example, would an investor pull out more money from Brazil as opposed to, say, in India, just as an example?
Yeah, I think a lot will depend on the changes in the weightings that MSCI announces. That's why it's actually very difficult for anyone to try and front-run it, because we don't really know how much is going to get reduced. Quite frankly, if some of the major EM indices get reduced by more, then therefore we can expect a further selling pressure from those indexes.
All right, Koen, point taken then. That's fairly interesting that maybe in fact we could be in for some more pressure if we're going by your reading of that one. But Koen, tell us about the Indian rupee then. It's at around 64 odd. What's your fair value of the rupee?
Well, I think rupee is actually not too far off from fair value in terms of long-term purchasing power parity. from a real effective exchange rate terms, I think it's probably a bit on the expensive side. Certainly, recent comments from some senior RBI officials suggest that they'd like to see the real effective exchange rate a bit lower. But quite frankly, around current levels sort of feels about fair, to be honest. I don't expect the rupee to depreciate too much from here. I mean, it has already come under quite a lot of downward pressure over the last couple of months. We're targeting 65 against the US dollar by the end of this year. The key near-term level we're looking at is really around 64.3, so that's quite a key near-term technical level. I think a major positive for the Indian rupee is the fact that the RBI has accumulated a large war chest in terms of their FX reserves. Therefore, they are in a much more comfortable position in order to manage any volatility in the currency, particularly in the event that the Fed starts to hike interest rates.
Okay. Koon, wanted your quick analysis on the dollar index as well. How much do you expect it to possibly move up to, as well as the euro, because it was fairly resilient yesterday despite what happened with Greece?
Well, I think the dollar index is going to continue to move higher. And I believe the dollar will continue to strengthen, particularly as we get closer towards the start of Fed policy normalization, because, you know, we are in an environment where U.S. monetary policy is really diverging from the rest of the world. U.S. is preparing the hike rates, whereas many other countries around the world are still easing policy. So that kind of divergence will continue to favor the US dollar. But I think where the bulk of the dollar strength will come from won't necessarily be amongst the developed market currencies. Euro, for example, it's been holding up remarkably well despite the ongoing situation in Greece. And I think that's because the economic data coming up from the Eurozone is starting to improve. We're not so afraid about deflation anymore. And I think the policies that the ECB has pursued is starting to have some impact, which is why you don't really see the market trying to push the euro down a lot more from current levels. But I think where most of the dollar strength will likely come true is via emerging market currencies. With the U.S. economy looking better and interest rates there expected to head higher, I think that's where you're going to see more of the pressure of a stronger dollar being expressed through, particularly those EM countries that still have fairly weak fundamentals in the form of large current account deficits, for example.
Okay. All right, Koon, we leave it on that note. Thanks very much for joining in and talking to us. So that's the view coming in from ANZ Research. 65 on the rupee is the forecast, at least in the end of the year.